What every retiree needs to know. Imagine spending 40 years working hard, saving every paycheck, and finally reaching retirement. You expect life to become simpler. But every year, tax rules change, and sometimes those changes can affect how much money stays in your pocket. In 2026, the IRS introduced several important updates that many retirees may overlook. These aren't flashy headlines. They're quiet changes hidden inside tax rules, inflation adjustments, and retirement regulations. Missing even one of them could mean paying more tax than necessary or making costly retirement planning mistakes. That's why this video matters. Today we'll break down 5 important IRS-related changes that could affect retirees in 2026. We'll explain what changed, why it matters, who may be affected, and what practical steps you should consider before filing your taxes or making retirement withdrawals. But before we begin, here's something many people don't realize. Retirement planning doesn't end the day you stop working. In many ways, that's when financial planning becomes even more important. Every decision, when to withdraw money, which account to use first, how much taxable income you report, and even when you claim certain benefits, can change your overall tax situation. A small mistake today can cost thousands of dollars over the next decade. The good news is that understanding these rules doesn't require you to be a tax expert. You simply need to know which changes deserve your attention. Throughout this documentary, we'll focus on official IRS guidance and widely recognized retirement planning principles. We'll avoid confusing tax jargon and explain everything in plain English with practical examples. Whether you're already retired, planning to retire soon, or helping your parents understand these changes, the information in this video can help you ask better questions and make more informed decisions. It's also important to remember that everyone's financial situation is different. Your income, retirement accounts, filing status, state taxes, and other factors all play a role. That's why this video is designed to help you understand the rules, not replace personalized professional tax advice. Now let's begin with the first major update. One of the biggest tax changes affecting many older Americans in 2026 involves additional tax relief available for eligible seniors. Who qualifies? How much could it reduce your taxable income? And what income limits apply? Let's break it down in rule number 1, extra tax relief for many seniors. Let's begin with the first important change. For many retirees, one of the biggest concerns is simple. Will I owe more taxes this year? The good news is that in 2026, some older taxpayers may qualify for additional tax relief, depending on their age, income, and filing status. But here's the problem. Many retirees never realize they qualify. Every year, thousands of Americans file their tax returns without fully understanding which deductions or adjustments may apply to them. That can mean paying more tax than necessary. If you're age 65 or older, the tax rules may allow you to claim additional benefits beyond the standard deduction, provided you meet the eligibility requirements. However, these benefits are not automatic for everyone. Your income level, filing status, and other tax factors all matter. For example, a married couple filing jointly may have different tax outcomes than someone filing as a single retiree. Likewise, income from pensions, retirement accounts, investments, or part-time work can affect your final tax calculation. This is why retirement taxes are often more complicated than many people expect. Another common mistake is assuming that because you're retired, you no longer need to plan for taxes. That's simply not true. In fact, retirement often requires even more careful tax planning because your income may now come from several different sources. You might receive Social Security benefits. You might withdraw money from a traditional IRA or 401k. You may also earn investment income or pension payments. Each source can affect your tax picture differently. That's why understanding available deductions and tax relief is so important. Even a relatively small reduction in taxable income may create meaningful savings over time. The key lesson isn't to search for tax loopholes. It's to understand the rules that already exist and make informed decisions before filing your return. In the next chapter, we'll move to another major retirement rule that surprises many Americans. Required minimum distributions. We'll explain when retirees are required to begin taking withdrawals, why the timing matters, and how one simple mistake could lead to unnecessary tax consequences if you're not prepared. Chapter 3. Rule number 2. The Required Minimum Distribution, RMD Rule. Now let's talk about one of the most important retirement rules in the United States. Required Minimum Distributions, commonly known as RMDs. If you've spent years saving money in a traditional IRA or a traditional 401k, there comes a point when the government requires you to begin taking withdrawals from those accounts. Many retirees assume they can simply leave that money untouched forever, but that's not how these retirement accounts work. The reason is simple. Most traditional retirement accounts were funded with pre-tax dollars. In other words, taxes were deferred while you were working. Eventually, the government expects those funds to begin flowing back into taxable income. This is where RMDs become important. Over the past few years, retirement laws have changed the age at which many people are required to begin taking these distributions. If you're planning for retirement or recently retired, it's essential to know which age applies to your situation, because it depends on when you were born. Another mistake retirees often make is waiting too long. If you miss an RMD when one is required, or you withdraw less than the required amount, you may face penalties unless the issue is corrected according to IRS procedures. That's why many financial advisors recommend planning your withdrawals well before the deadline instead of waiting until the last minute. Timing also matters for another reason. Every dollar you withdraw from a traditional retirement account can increase your taxable income for that year. In some situations, a larger withdrawal may even affect other parts of your tax picture. That's why many retirees work carefully through a withdrawal strategy instead of simply taking money whenever they need it. The goal isn't just to withdraw money. The goal is to withdraw it in the most tax-efficient way possible. Remember, retirement isn't only about building wealth. It's also about protecting it. Understanding required minimum distributions is one of the smartest steps retirees can take to avoid costly surprises. In the next chapter, we'll look at another important 2026 update, how inflation adjustments may change tax brackets and standard deductions, and why even small changes could affect how much tax you pay in retirement. Number 3. Tax brackets and standard deduction changes. Now let's move to another important change that could affect millions of retirees in 2026. Tax brackets and the standard deduction. At first, these updates may not sound exciting, but they can have a real impact on how much tax you pay. Here's why. The IRS regularly adjusts many tax figures to account for inflation. That means income thresholds, tax brackets, and the standard deduction can change from one year to the next. For retirees, even a small adjustment can make a noticeable difference. Imagine two retirees with almost the same income. One falls just below a tax threshold. The other falls just above it. That small difference could affect how much of their income is taxed at different rates. This is why understanding tax brackets matters. Many people believe that earning a little more money means all of their income is taxed at a higher rate. That's not how the U.S. tax system works. Instead, different portions of your income are taxed at different rates. Understanding this can help retirees make smarter decisions about when to withdraw money from retirement accounts or realize investment gains. The standard deduction is also important. Many retirees claim the standard deduction instead of itemizing deductions. When the IRS adjusts that deduction, it may reduce the amount of income that's subject to federal tax. That doesn't mean everyone will pay less. Your final tax bill still depends on your total income, filing status, retirement account withdrawals, and other personal circumstances. But these annual adjustments are one reason why reviewing your retirement plan every year is so important. Many people simply repeat the same strategy year after year without checking whether the tax rules have changed. That's a mistake. Smart retirement planning isn't about making one perfect decision. It's about making better decisions every year as the rules evolve. Before taking large withdrawals, selling investments, or making major financial moves, many retirees choose to estimate how those decisions could affect their taxable income. A little planning today may help reduce unnecessary taxes tomorrow. In our next chapter, we'll discuss another important retirement strategy involving qualified charitable distributions, and why many retirees use them as part of a tax-efficient giving plan while supporting causes they care about.